Imagine discovering that a tiny, $300 a month credit card bill is the single barrier standing between you and the exact home you want to buy.
Oh, it happens all the time.
Right, because you think you're in great financial shape, but to a mortgage underwriter, that one small monthly payment is just this giant red flag that drastically shrinks your buying power.
Yeah, it was entirely counterintuitive. I mean, people often assume that securing a mortgage is just about, how much money you have in your checking account or just being a generally responsible person.
Yeah, totally.
But the reality is far more mechanical. It's a very specific game and it has very rigid rules.
And if you don't know the rules, you're going to lose the game. So our mission today is to decode this entire process. We're doing a deep dive into an article outlining strategies on how to increase your mortgage pre-approval amount.
Which is such a crucial topic.
It really is. We're going to figure out exactly how to push your pre-approval number higher when the initial amount a lender offers just won't cover the home or the neighborhood you actually want to live in.
Right, because that initial number can be a real shock.
Huge shock. But first, just to set the baseline for you, what exactly is a pre-approval? I mean, it is basically a document indicating that a lender has looked at a snapshot of your finances and, well, conditionally approved you to borrow a specific amount of money.
At a specific interest rate, yeah.
Exactly. It's not an absolute ironclad guarantee that they will hand you the cash on closing day, but it is a highly likely indicator. And more importantly, it's the golden ticket you absolutely must have in your hand before a seller will even look at your offer.
Right. Without it, you are just window shopping. But the friction really happens when you finally get that piece of paper, you look at the number, and you realize it leaves you entirely priced out of your target market.
Okay, let's unpack this. Think of getting a mortgage pre-approval like being handed a strictly enforced budget before going grocery shopping. Except, you're going grocery shopping on an empty stomach.
The worst time to go.
Exactly. You're starving, you want the premium stuff, but the store manager hands you a $20 bill and says, that's it, make it work.
Good luck with that.
Right. If that budget is too low, you have to prove to that manager that you are good for a few extra bucks. But they don't just magically decide to give you more money because you ask nicely or because you promise you're good for it.
No, they definitely don't.
You have to manipulate the specific mathematical levers that they actually care about. And the absolute biggest, most immediate lever in this entire process is your debt.
Yeah, debt is really the foundation of how a lender views your financial health. And they measure it through a very specific lens called the debt-to-income ratio, or DTI.
DTI, right.
This is the first major hurdle for you. Ideally, lenders want to see your DTI at 36% or less.
So meaning what exactly?
That means if you take all your fixed monthly debt obligations, so your student loans, your car payments, minimum credit card payments, and of course this projected new mortgage, all of that combined should not eat up more than 36% of your gross monthly income.
Which leaves the rest of your income for, actually living, paying taxes, buying groceries, keeping the lights on.
Exactly, just surviving.
But let's put some real numbers to this, because there's a scenario from the source text we're exploring today that perfectly illustrates how weird this math can be.
Oh, the credit card example. I love this one.
It's so good. Let's say you have a credit card with a total balance of $2,000. Not a massive amount of debt in the grand scheme of things, right?
Not at all.
But the minimum monthly payment on that specific card is $300. Paying off that relatively small $2,000 balance entirely is actually one of the fastest, most straightforward ways to significantly increase your mortgage pre-approval amount.
It is practically an instant fix.
Yeah.
Oh, absolutely. Because the moment you wipe out that $2,000 balance, that $300 monthly liability just vanishes from your DTI calculation.
Right. Okay.
You suddenly have $300 more in theoretical monthly cash flow to put toward a mortgage payment. And in the eyes of the bank, a borrower who can afford an extra $300 a month, well, they can afford a significantly larger total loan.
But, what if you don't have $2,000 in cash sitting around to just wipe it out?
Yeah.
Because there are alternative strategies to lower your DTI without necessarily paying off the principal amount right away.
Yeah, you have a few options there.
Like you could use a zero-interest balance transfer card to drop that monthly minimum payment way down.
Yeah.
You could refinance an auto loan to stretch the term out over a few more years, which lowers the monthly hit. Or you could consolidate several debts into one installment loan.
Right, exactly.
Essentially a seesaw. Lowering your monthly obligations on one side immediately raises your buying power on the other side. But I have to push back on this a little bit.
Go for it.
If I just shuffle my debt around with a consolidation loan or a balance transfer, I mean, I still owe the exact same amount of money. I haven't magically become wealthier. Doesn't a sophisticated mortgage underwriter see through that trick? Or do they strictly only care about the monthly math?
What's fascinating here is how lenders assess month-to-month cash flow survival. We tend to think of debt in moral terms.
Yeah, like having a high principal balance is inherently bad, and paying it off is inherently good.
Right. But lenders don't care about your morals. They aren't making a philosophical judgment on the total principal you owe across your entire lifetime.
Okay.
They are looking at a much more ruthless, practical question. They want to know, next month, on a random Tuesday in November when the bills come due, does this person have enough liquid cash coming in to pay us, pay their other creditors, and still eat?
Ah, so it's not a character assessment at all.
Correct.
It is literally just a monthly survival calculation.
Precisely. Like a massive principal balance on a low-interest student loan might look incredibly scary to you, but if the monthly payment on that loan is tiny, the lender knows you aren't going to be squeezed for cash day to day.
Oh, that makes total sense.
Conversely, a tiny total balance on a high-interest credit card, but with a massive minimum monthly payment, that is a huge red flag for them. It violently eats up your monthly liquidity.
Right, it's just draining your cash.
Exactly. So no, shuffling debt to lower the payment isn't a trick. It is actively demonstrating to the underwriter that you are managing your monthly cash flow in a way that prioritizes survival and stability.
That reframes the whole concept for me. So if lowering the debt side of the DTI seesaw is our first major tactic, the natural next step is looking at the other side of that fraction.
The income side.
Right. If we can't lower the debt any further, we need to increase the income variable. Now, the instinctive reaction is that you need to, march into your boss's office and demand a massive raise or find a completely new, higher-paying job.
Which is obviously easier said than done, especially on a tight timeline.
Totally. Fortunately, your primary salary is crucial, but it's far from the only thing an underwriter will consider. The source points out that lenders will factor in a surprisingly wide variety of reliable income sources.
They really do.
The list of what actually counts is fascinating. They will factor in interest or dividends from investments. They will count rental property income. They look at alimony or child support payments.
Yep.
And, of course, income from a pension, a retirement account, or Social Security benefits. Here's where it gets really interesting. Think of building your mortgage application like assembling an Avengers team of income streams.
I like that.
You are not just relying on your main salary superhero to do all the heavy lifting and fight the villain alone. You are bringing in all the sidekicks, your dividend payments, your weekend side hustle, your rental income. They all assemble to battle the debt-to-income ratio together.
The Avengers analogy is great, but there is a very strict rule for when those sidekicks are actually allowed to join the fight, particularly when it comes to side hustles and part-time jobs.
Okay, what's the rule?
The golden rule in underwriting is the 2-year rule.
Oh, right. You must have earned that part-time or side business income for at least the past 2 years for it to count toward your pre-approval.
Exactly. You cannot just decide you want to buy a house, start driving for a food delivery app for 3 weeks, run a spreadsheet showing you made $500, and then claim an extra $2,000 a month in projected annual income.
I mean, that makes sense.
Yeah, the underwriter will immediately throw that out.
But why is that 2-year benchmark so rigidly enforced? Why not 6 months? Why not 1 year?
Because lenders love predictability over potential.
Predictability over potential.
Right. If you just started a side business, you might be incredibly talented and have a massive amount of potential. But potential doesn't pay a 30-year fixed-rate mortgage.
Yeah, you can't pay the bank in potential.
Exactly. A 2-year track record, fully documented on your tax returns, shows them undeniable predictability. It proves that this income isn't just a temporary, frantic sprint to gather cash for a down payment, but rather a sustained, reliable addition to your baseline financial picture.
So they want to know it's a habit, not a phase.
Yeah. The lender's entire mindset is about mitigating risk. To a bank, stability is the ultimate antidote to risk.
Okay, so you have optimized your debt. You've brought in the Avengers, categorized all your sidekick income streams, and you've got 2 years of tax returns to prove it. You are looking solid.
Very solid.
But getting approved for a certain amount of money is only half the battle. The next major metric we have to dive into dictates the actual cost of borrowing that money.
Yes, the interest rate.
Right. We are talking about the interest rate, and the gateway to your interest rate is your credit score.
There is a very direct, undeniable chain reaction here. It's basic mechanics, but it's just vital to understand.
Walk us through it.
A higher credit score equals a lower interest rate offered by the bank. A lower interest rate equals a lower monthly payment required for the exact same amount of borrowed money.
Okay.
And what happens when your projected monthly payment drops? Your debt-to-income ratio improves, which means keeping all your other income exactly the same, you suddenly qualify to borrow a larger total loan amount.
It is a giant feedback loop. Everything feeds back into that DTI formula.
It's
So how do we push that credit score up to trigger this chain reaction? Because there are a few very specific, highly effective strategies from the article to deploy.
definitely.
First, obviously, pay all your bills on time. Second, pull your credit report and aggressively dispute any errors you find. You'd be shocked how often a random incorrect collection account just drags down a score.
It happens all the time.
And third, use your credit card sparingly. Ideally, keep your usage below 30% of your total limit.
Yeah, that is your credit utilization ratio, and it is a massive component of your score.
How does it work exactly?
Well, if you have a $10,000 limit and you consistently only carry a $1,000 balance, the algorithm sees someone who is trusted with a lot of rope but chooses not to hang themselves with it.
Right, it shows restraint.
Immense financial restraint. But if you are maxing out $9,000 of that $10,000 limit, the algorithm sees desperation.
Which leads perfectly into the fourth strategy. Avoid applying for any new credit cards or loans right before you apply for a mortgage. Don't go finance a new car the week before you want to buy a house.
Oh, please don't do that.
It's a disaster. Fifth, you can actually request higher credit limits on your existing cards. Because if you don't spend any more money, raising the limit artificially lowers your utilization ratio.
It's a great little adjustment.
And finally, report your rent payments to the credit bureaus.
Mm-hmm.
But hold on, I need to stop and ask about that last one.
The rent recording.
Yes. Why does retroactively reporting my rent suddenly make me look like a less risky borrower to a computer model? I mean, my actual financial habits haven't changed at all.
True.
I am the exact same person I was yesterday, making the exact same amount of money, paying the exact same rent.
This raises an important question about how credit algorithms actually work, and it's a massive blind spot for a lot of consumers. Yeah. The algorithm cannot measure your character. It cannot measure your integrity, your intentions, or your quiet, undocumented responsibility. It can only measure your documented data trail.
So it's literally just picks or it didn't happen for the financial world.
That is the perfect way to phrase it. Yes. You might be the most profoundly responsible renter in the entire world. You might have faithfully paid your landlord on the first of the month without fail for 10 straight years.
Right.
But if that data isn't being explicitly fed into the specific bureaus that generate your credit score, then to the algorithm, that 10-year history of responsibility simply does not exist. You are a ghost.
Wow. Okay.
So when you initiate rent reporting through a third-party service, you are finally feeding the machine the data it needs to accurately calculate your historical reliability. It's not changing who you are. It's just forcing the system to finally give you credit for the responsibility you already possess.
Okay, that clarifies things.
Yeah.
We are just giving the algorithm the proof it demands. Now, there's a sobering caveat to all this credit score talk that we definitely have to mention.
Oh, for sure.
A higher credit score may allow you to qualify for a higher mortgage amount, but only to a certain extent. It is not a limitless superpower.
Right. A perfect 800 credit score doesn't mean a bank will let you borrow $2 million if your income is only $50,000 a year.
Yeah, that would be crazy.
The credit score optimizes the cost of the debt, the interest rate, but your actual cash income still puts a hard cap on the total volume of debt you can carry.
Which perfectly transitions us to a really fascinating, highly leveraged strategy, buying down your rate.
Oh, this is a good one.
If you have extra cash on hand, you can literally pay something called points up front to buy down your interest rate.
This is an incredibly powerful tool if you plan on staying in the home long term. A point is simply a fee equal to 1% of your total loan amount.
So just to do the math, if you are borrowing $400,000, 1 point costs $4,000 in cash at closing.
Exactly. And by paying that $4,000 up front, you are effectively prepaying some of the interest to the lender in exchange for a permanently lower interest rate for the entire life of the 30-year loan.
And doing this lowers your monthly payment, which again helps your DTI and helps you qualify for a larger mortgage up front.
And it saves you money overall.
Right. It saves you tens of thousands of dollars over the decades. It's an upfront investment for a massive long-term payoff. And alongside paying points, simply having cash reserves like actual liquid assets sitting in a savings account can also help you qualify for a bigger loan, even though underwriters don't strictly require it.
Cash reserves act as a financial shock absorber. Lenders sleep much better at night knowing that if you lose your job or, your furnace explodes the month after you move in, you have a cushion of liquid assets.
Right, so the emergency is handled and the mortgage payment still gets made.
Exactly. If you have zero reserves, one bad week means the bank doesn't get paid.
So let's say you have done everything right. You are a model applicant. You have maxed out the optimization of your own internal numbers.
Your ducks are in a row.
Your debt is paid down, your income streams are fully documented, your credit score is pristine, and you have some cash in the bank. But if the pre-approval number they hand you is still not where you need it to be to buy the house you want, the final frontier is looking outside yourself to external leverage.
Yes.
We're talking about utilizing other people and other banks.
The most common external lever is adding a co-borrower. By bringing someone else onto the mortgage application, like a spouse, a long-term partner, or a parent, you get to combine your incomes.
Which is huge.
It is. This massively increases the total income the underwriter can use to calculate your buying power.
But there is a very stark warning that comes with this strategy. A co-borrower doesn't just bring their income and assets to the party. They bring all of their liabilities, their debts, and their credit history to the table, too.
Everything comes with them.
So what does this all mean? Think of adding a co-borrower, like entering a financial three-legged race. You might be the fastest, most financially fit runner in the world. But if your partner is dragging a history of bad credit or heavy credit card debt, you both go down.
You're tied together.
You are fundamentally tied together in the eyes of the underwriter. If they have bad credit, adding them could absolutely destroy your chances rather than help.
It's a huge risk. The lender will often look at the lowest middle credit score between the two borrowers.
Wait, the lowest middle score?
Yeah. So a strong borrower with an 800 score can actually be dragged down by a weaker co-borrower with a 620 score.
Yeah.
You have to run those numbers very, very carefully before combining forces. It is not an automatic win.
That is so important to keep in mind. Speaking of numbers, let's look at the ultimate magic number in the real estate world, the 20% down payment.
Yeah.
If you can leverage your savings, sell some assets, or perhaps utilize a financial gift from family to hit that 20% threshold of the home's purchase price, the entire game changes.
It changes significantly, primarily because hitting 20% completely eliminates the need for private mortgage insurance, commonly known as PMI, on conventional mortgages.
Let's pause and explain PMI, because I think a lot of people hear the word insurance and instinctively think it protects them, like auto insurance or health insurance.
Oh, that is perhaps the greatest misconception in real estate.
It really is.
PMI offers zero protection to you, the borrower. If you lose your job and can't pay your mortgage, PMI does not step in to save your house.
No.
It is an insurance policy that you are forced to pay for every single month, but the policy solely protects the lender in case you default on the loan.
So if you stop paying and they have to foreclose, the insurance company cuts a check to the bank.
And you get nothing. It's essentially a monthly penalty fee for not having enough skin in the game up front.
It's literally just burning your own money to make the bank feel safer.
Exactly. But when you put down 20%, you have enough immediate equity in the home that the lender feels their risk is thoroughly covered by the property's value alone.
Okay, that makes sense.
And by eliminating that monthly PMI payment, which can be hundreds of dollars, by the way, you instantly free up more space in your DTI ratio.
There's that seesaw again.
Yep. Plus, lenders generally view anyone putting down 20% as a fundamentally less risky borrower, making them far more willing to increase your total loan amount.
Which brings us to our final piece of external leverage, playing the field. The absolute strongest advice is getting at least 3 different quotes from 3 different lenders.
This is a crucial, often overlooked step.
Why do people skip it?
I think they just get fatigued by the process, but not all lenders use the exact same internal risk models or have the same business goals.
Oh, interesting.
Yeah. One lender might naturally offer you a significantly higher pre-approval amount right out of the gate simply because their institutional appetite for risk is higher that particular week.
But beyond just rolling the dice and hoping for a naturally better initial number, multiple quotes give you something incredibly valuable.
Leverage.
Leverage is everything. You can go back to your preferred lender, maybe the one with the best customer service or the local credit union you love, and use a competitor's higher pre-approval to negotiate. You can put the paper on the desk and literally ask them, can you match this?
If we connect this to the bigger picture, it is so easy to forget that lenders are businesses.
Right.
They are actively competing for the privilege of holding your debt for 30 years. A mortgage is a highly profitable product for them. You are the customer.
That's a huge mindset shift.
It is. Using multiple quotes as leverage is a powerful reminder that you, the borrower, have agency and power in this dynamic. You aren't just going hat in hand begging an institution for money. You are shopping around for a massive financial product, and they want your business.
So bringing this all together, what is the grand synthesis of everything we've explored today? The ultimate truth here is that there is no single magical calculator where you punch in your salary and it spits out a perfect pre-approval number.
Not at all.
Mortgage underwriters are looking at dozens, if not hundreds, of data points about your life. They are building a highly complex, multi-dimensional model of your financial existence.
And borrowers with lower scores, uneven income histories, or high monthly debt obligations will undoubtedly qualify for less.
Right. The gold standard, the ultimate goal to strive for, is strong credit, little to no monthly debt, and high, steady, documented income.
It's an intricate puzzle. Changing one single piece like paying off that one $300 credit card bill or reporting your rent to boost your score by a few points shifts the entire picture and can open up entirely new neighborhoods for you to look at.
And for you listening, armed with an understanding of how these mechanical levers actually work, how your DTI functions as a seesaw, how alternative income requires a 2-year history of predictability, how your credit utilization changes your interest rate, and how you can actually negotiate with multiple banks, you can step into your real estate journey with absolute confidence. You do not have to feel overwhelmed by the mountains of paperwork because you now know the logic behind the math. You aren't just reacting to a number they hand you. You know how to engineer a better one.
You finally understand the mechanics of the machine. But before we wrap up today, I want to leave you with one final thought to mull over.
Let's hear it.
We have just spent this entire deep dive learning how a bank uses hundreds of data points to ruthlessly assess if you are a safe bet for them. They scrutinize your cash flow, they dig into your history, and they stress test your liabilities entirely to protect their own bottom line.
Right.
But how often do we use that same rigorous, multifaceted analysis to assess if taking on a massive 30-year loan is actually safe for us? The bank is spending hours underwriting your risk to their profit margins, but are you taking the time to underwrite the loan's impact on your own life, your freedom, and your future?
Wow. Now that is a question worth asking before you sign anything. Thank you so much for joining us on this deep dive. Take that knowledge, use your leverage, and we will catch you next time.